people ask me, is there anything that the US could do or the West could do to, to pull themselves up from their bootstraps? I found it very interesting in 2020 when the International Monetary Fund came out and asked for a new Bretton Woods. The IMF, 150 countries from around the world, was founded at Bretton Woods. Well, not so coincidentally, just the other day, they published a report that said something to the extent of gold as an international reserve, a barbarous relic no more.
Monaco 64, home of alternative economics and contrarian views. Today, I have the pleasure of speaking with Andy Schechtman of Miles Franklin. I spoke to him in December, and yeah, it's nice to have you back, Andy. How are you?
Mario, I'm great, my friend. It's wonderful to see you. Thank you for having me, and I'm great. Hope you're doing well too.
Yeah, I'm doing well. We have a new member of the channel. I showed you Rudy earlier. He's growing quickly, and hopefully he'll be on the couch soon. But anyway, I wanted to ask you where you see things in terms of the U.S. economy, the de-dollarization. I just saw an article. It was an interview of John Paulson. I don't know if you heard of him.
Yeah, I saw that.
Yeah, famous hedge fund manager, and he mentioned in this interview, he said, we have a big hangover coming. At some point, we'll have to either repay the debt or inflate the economy to monetize the debt. So maybe we could start with that.
Yeah, well, I mean, that's the same, Richard Russell always used to say, even 15 years ago, the Fed is in a pickle. They will either inflate or die. In other words, inflate or just flat out default on the debt. There's no question about that. When the speed in which the debt is rising, in fact, you can talk about the economy and where we are in terms of the biggest inversion in the yield curve in over 40 years, and most every single inversion in the yield curve has been a precursor to a recession. This is a very, very, very long inversion. It's much longer than previous inversions and much steeper than most. I think you could certainly say that in terms of an economy, we are heading towards some sort of a deep recession. I've even heard some people say that we are heading towards some sort of a depression. But look, there is no question about it that we are reaching that moment where we're going to have to deal with this debt. And when you talk about how bad it really is, look, in 2019, the federal government brought in nearly $5 trillion in tax revenue, but just under $4.9 trillion. And if you go back to 2019, that would have covered the entire federal budget and left $500 billion over to pay down the debt. But instead, they added close to $1.4 trillion, spending over $6.25 trillion in fiscal year 2022. And what is lost on a lot of this is that $706 billion of that money went just to pay the debt. And now they're having to borrow money to pay, just simply to pay the interest on the national debt. And they're borrowing money to pay interest on what they've already borrowed money on. And so this is a cycle that at some point has to end, and probably rather abruptly. And I think this is part of the reason why you're seeing such massive and rampant de-dollarization. And at some point, the rubber is going to meet the road. And when you talk about, there's all this fixation of a soft landing and of inflation subsiding, and I don't think it is. The Fed has missed so many of these things. They said inflation's not a problem, then it's transitory, then it's structural, then it's peaked, and now it hasn't peaked. The service sector has gone up hotter than we had expected. But when you see OPEC just announce a 2 million barrel per day decrease in production, when you see Russia say 550,000 barrels per day, you're going to see energy continue to rise and probably much faster than the politicians would like. This is why you see Biden go back into the strategic stockpile, pillage another 25 million barrels of oil, because they're afraid of what that really means. And what that means to me is you're going to see a hawkish Fed, that they can't pivot the way the bond traders have been thinking that they would. Now, again, you got the bond market being the smartest market on the planet. So who am I to say they're not going to pivot? But maybe that pivot comes in the face of much higher interest rates. You got one of the New York Fed members, John Williams, not John Williams of Shadow Stats fame, but John Williams of the New York Fed, calling for 5.5% on the federal funds rate. When we get to 6%, we're pretty much at the point of no return. And at that point, you're going to start to see the markets really start to crumble, especially when you look at the speed at which they've risen the rates. Now, I think the rates in and of themselves have been pussyfooting. They haven't raised them high enough yet to go above the rate of inflation, but the speed hasn't really factored its way into the economy yet. There's a lag time. And when that hits, coupled with rising rates, coupled with higher energy costs, coupled with continuing inflation, I think that the Fed isn't going to pivot this year the way that conventional wisdom thinks it will. That soft landing we're talking about, I don't see it. And that's probably why you're seeing such massive de-dollarization at a speed that I think is shocking most analysts, myself included.
Yeah, I also saw that the Bank of Japan has done about $600 billion, not yen, of QE since late last year, while the Fed has cut the balance sheet by 300. So net, the Japanese are helping. But I agree with you about the Fed. They have a really tough quandary in their hands, because they really need to raise rates to probably 8 or 9% to stop the inflation. I saw that the Central Bank of Brazil, which got its independence, I think, a few years ago under Bolsonaro, they've kept their rates at 13.75%, and their CPI now is 5.7%.
That's how you do it. That's how Paul Volcker did it.
I mean,
that's how you get rid of inflation.
Yeah, I mean, until they do, but if they do that in the U.S.,
all hell breaks loose.
Yeah, because it's not just the national debt; is all the derivatives out there, all the corporate debt, consumer debt. I mean, it's a mess. So,
and this is why the FDIC Systemic Resolution Advisory Committee, and in their November meeting that is now all over the internet, came out and said there will be bank runs, there will be bail-ins. There's no question that the institutions know this already, and that the members of the board in that room have less confidence in the banking system than the public does. And although the public needs to know there will be bail-ins, we can't let them know this, because that will create unintended consequences and a run on the bank. You look at Credit Suisse, who's in a death spiral, who's lost money 4 or 5 quarters in a row, watched $100 billion withdrawn by depositors in the fourth quarter. This is exactly what they're talking about, because Credit Suisse is one of the systemic too big to fail banks. If they fail, does that bring about a daisy chain that you start to see other banks that are systemically tied together fail? Is this what the FDIC Systemic Resolution Advisory Board is talking about? That there will be bail-ins, that there will be bank runs, that there will be bank failures. They're admitting it. Of course, I don't know that they thought it would get out to the public, but that's exactly what you're talking about. And I completely and totally agree that the derivatives that are out there, which all are valued based upon a counterparty's ability to perform, are a real big problem in an interest rate rising environment where banks and institutions are going to have a very hard time meeting obligations, and defaults are going to create a big problem in an incestuously systemic environment that we see. And when you look at the Swiss, I think the name is the Swiss Bank Corp. It's the second biggest bank in the world that the Fed just bailed out with $10 billion, and they fired 9,000 of their employees after. Why is the Fed bailing out a bank in Switzerland and not the Swiss National Bank? This is a problem, and they understand it. And when you add to the mix that the Fed, which is always there to save us, has taken on since 2008 a balance sheet of $9 trillion, most of it on long maturity, low interest rate assets like 30-year mortgages and treasuries, yet have massive short-term obligations in the reverse repo market of $2.5 trillion, and the reserve fund that the commercial banks put their money in, both of which are paying between 4 and 5%. Massive short-term liabilities against long-term assets at low interest rates, high interest rates on the short term. They're $31 billion in the red right now. So their operational losses are growing by the day, and their balance sheet is close to 200 times leveraged right now. So they're not in a position to come in and help in that type of an event. These are very, very interesting times, and as you know, that's a Chinese curse. But when you look at the other side of the coin, the de-dollarization that's going on, oftentimes I focus, Mario, on gold and silver as being the de-dollarization tool. There was a very interesting report that just came out by JP Morgan, perhaps you saw it, but they basically said, here's what China currently holds. 80% of the global copper inventories, all we hear is copper is getting hard to find, 70% of the global corn inventory, 51% of the global wheat, 46% of the global soybean inventory, 70% of global crude, and over 20% of the global aluminum inventories. The London Metals Exchange watched over 70% decline in their aluminum inventories last year. Where do you think it's going? Not to mention, they're aggressively stockpiling every ounce of gold they can find, and a country like India is importing 304 million ounces of silver last year. These are all forms of de-dollarization and building a war chest, if not in preparation for war, at the very least de-dollarization, which is only beginning to gain steam, and that will only add fuel to a fire, especially if Saudi Arabia gets into the mix, who just joined BRICS, who just said that China is their most important trading partner in oil this year and for the next 50, and in Davos last week said we are open to taking oil purchases in other currencies. You put all of this together, and the speed at which this is all spinning points to a dollar that's in real trouble ultimately. Now, when is that going to be? Don't know. I am the poster child for the little boy who cried wolf. At the end of the story, the wolf comes. But mathematically and economically, and with the sprinkling of old school logic, it's coming. You can see the pieces put in place. And that's why you're seeing massive drawdowns off of the LME, off of COMEX, and countries like India and China and many others stockpiling real things and shedding debt instruments like U.S. treasuries. It's the perfect storm that's waiting to happen. No question about it.
Yeah, moving over to gold and silver, one would have thought, because people always say, well, when interest rates rise, it's bad for gold and silver. And I've always said that in the 70s, interest rates rose like from 4.5 or 5, all the way up to like 16% almost in the 10-year, and gold went from $35 to almost 900. So looking back at last year, when we saw the central banks, not just, well, the Fed started raising rates, and then the ECB and the Bank of England follow, we actually saw silver slightly up on the year in dollars and gold unchanged. So I think they did very well. So my question to you is, how do you think they will perform despite the fact that you expect the Fed to remain quite hawkish and not really pivot?
Well, in fairness, what you are speaking about is Gibson's paradox, which is the inverse relationship between real interest rates and the price of gold. And why do you think they go to such great lengths to blur what is reality in the CPI? They just changed the metrics again. John Williams of Shadow Stats will tell you inflation's at 15% right now. But okay, so we believe the 6.5% inflation, which everyone knows that's a lie. But even still, the federal funds rate is still 2 full points below that. So the real return is negative 2% compounding over 10 years on the 10-year treasury. That I'd rather take gold earning nothing than an asset that has all sorts of systemic risk tied to it that is yielding a negative 2% compounding return. And as rates rise, what that is signaling in this environment is a dollar that's sick and very sick. And the rates that are going higher are in response to the de-dollarization, that no one wants to hold dollars anymore. So as the dollar starts to decline in value, you will see higher rates, right? And as inflation continues, you will see higher rates. But that is a phenomenon that is I think offsetting the weakness of the reality, the weakness of the dollar and the inflationary effects. You reach a point, like you were saying with the real, I think it's in Brazil, where the rates are higher than the level of inflation, so that the real return is positive. And if you use the rule of 70 seconds as your metric, where you take the interest rate and divide it into 72, and it tells you how long before your principal doubles, using -2 as your guideline, you got a long way to go. But if you look at a real return in that example you gave of 6 or 7%, 7% real interest rate in 10.2 years, your principal doubles. Okay, I can understand that would put a damper on gold. But these analysts who want us to believe that, oh, the Fed funds rate's up to 4%, but it's not even near inflation yet. It's only 2/3 of the lying CPI number, and probably 10 points off the real number. Well, that shouldn't matter at all. That's just rhetoric by a media who really doesn't know what the hell they're talking about when they talk about, these rate increases will be tough on gold. If you think about it, your return is negative. So why would it? It shouldn't. And Gibson's paradox speaks to the real return, not to the nominal return, as those analysts are talking about.
I want to show you this story here. I'm going to share it with you and the viewers. I saw this earlier today. I thought, and it's from the FT. It says missed signals behind Trafigura's 577 million loss on non-existent nickel. Commodity Trading Group discovers shipments that did not contain any trace of valuable metal. And I thought of silver and gold, and
Yeah.
when is that going to happen to silver and gold? I guess the derivatives markets, the futures market, and the LBMA, and even the LME for base metals, it allows the big institutions to manipulate the price and throw paper at it. So if you'd like to learn more about silver manipulation, I highly recommend you download this exclusive report by the Wealth Research Group. It goes back all the way to the Hunt brothers and to present day silver manipulation by JP Morgan. There's a link to the report below in the description. But every once in a while, yeah, you get like this kind of problem where people wake up and they realize there's nothing, they see that the emperor is wearing no clothes. So this is, I think, a symptom of the manipulation, not just of gold and silver, but also of all the markets. I mean, I spoke to Paul from the Sirius report yesterday, and apparently the Bank of Japan, they own more than 100% of some JGB issues. How is that possible? So everything seems to be warped.
Yeah, that's called rehypothecation. But how, I mean, if you look at the silver market as an example in relation to your story here on nickel, the LBMA just came out and said if withdrawals off of the LBMA are similar to what we saw in 2022, they will be at or near no silver available on the 140-year-old exchange. If you look at the COMEX market, there is 280 some million ounces in the entire COMEX silver stockpile, of which only about 35 million of them are in the registered category. Those are bars that are available for delivery, backing the contracts. That means 250 million of the 280 million ounces, roughly, are held in strong hands by people like me or my clients or family offices that have no intention of selling whatsoever. And you look at what Ted Butler talks about, the massive amount of volume back and forth and back and forth and back and forth by these commercial banks trying to simulate that this is a robust market. What it simulates to me is that they're running out of silver. When the Central Bank of India can import 304 million ounces, and yet that's almost 10 times the amount of silver backing the registered category on the COMEX, it tells you that nickel moment isn't too far off, that we are being misdirected by levered futures contracts, and a few of the cartel banks that are doing this, holding it all together. You look at the LBMA, 90% of their zinc has been bled off the exchange last year, and 75% of the aluminum. And so these commodities that we talk about, nickel and aluminum and zinc and copper, this is wealth to the Chinese. This is wealth to the BRICS nations. They understand, if you, like Zoltan Pozar says, last time we talked a little bit about Zoltan. Bretton Woods 3, a system dominated by commodities and not debt instruments, real things. So whether, when you look at what China is accumulating and saying that's a war chest, whether they're preparing for real war or economic war, it all boils down to one phrase, and that is de-dollarization. These countries and these big money centers would rather own the real thing in place of dollars, because in the end, the real things are what matters, and not the illusion of wealth that is created through currencies and treasuries that are not only manipulated, but are losing value precipitously and are being administered by governments that will do as all governments have, and that is choose inflation over austerity if given the chance. So there's no surprise by me to see these countries massively accumulate things like nickel, which are needed copiously in industry, and without it, you're SOL. So yeah, I think we'll start to see more stories like this. And then you throw derivatives onto it, which ignite the fuse. This could become a very scary situation really very quickly.
So gold and silver, I mean, I couldn't think of a better person than you to tell those viewers who have never bought gold and silver or are thinking about buying gold and silver, the way to start with gold and silver.
Well, to me, the way to start with gold and silver is to just simply focus on the number of ounces. As Richard Russell always said, in the end, it is the number of ounces that matter. Now, I would add to that, you don't want to be penny wise and pound foolish and accumulate large chunks of gold and silver over those that will give you utility and flexibility. There is a desire in this industry to be penny wise and pound foolish, to maximize what your dollar or whatever currency you're trading in here in the States, your dollar will afford you. And I get that. That's normal. And we're all built that way, to maximize what we can spend. But I will tell you, you can have the greatest thing in the world, and if it lacks utility, you'll wish that you would have done it a different way. What I mean by that, I don't know if there's Costco in the UK, but Costco here in the States is, a big box store where you go and buy huge amounts at one time. If you want to make yourself a tuna fish sandwich, you don't go to Costco to get a can of tuna fish. I guess what I'm saying is that there is a level of utility that must be thought about when you're adding to your portfolio. So a kilo bar, which is 32.15 ounces, which will cost more per ounce than a 1,000-ounce bar, but it's 300 times more liquid. To me, I would say the savings you get in buying a 1,000-ounce bar is not commensurate with the loss of flexibility in buying that 1,000-ounce bar when compared to 100 or a kilo or a 10. So the bottom line is this: it is about number of ounces that matter, but you do want to make sure that you have good liquidity and flexibility and utility in order to use that, whether it be for an emergency, God forbid, or for an opportunity, or whatever it may be. And who knows how high metals will go. Having the extra utility is a really good deal. Now, converse to that, you don't want to go and start buying fractional gold and silver because the premiums will be really high. So find a sweet spot that gives you good bang for the buck while not diminishing or decreasing your utility. That's typically how I would focus. And I would look to gold and silver bullion. So whether you're talking where you live, the Britannia in the United Kingdom, or the Philharmonic from Austria, or the Kangaroo from Australia, or the US Eagle, or the Canadian Maple Leaf, or the Krugerrand, or bars, it doesn't matter. You want things that people want, and you want things that will give you utility. At the same time, we're always cognizant of value, but it's very easy. Buy bullion, buy from one of the 6 major mints or refineries that are very respected, such as Valcambi or Pamp Swiss or the Perth Mint or the Royal Canadian Mint. There are many others, but buy from a reputable source, buy bullion, and maximize the number of ounces you can get. Be cognizant of the utility, the size, and find a happy medium between the price per ounce and the liquidity and flexibility that what you get affords you, should you ever need it to use it.
So in North America, and many of you know I'm in the UK, but in North America, I have complete trust in Andy Schechtman at Myers Franklin, and I've been partnering with him for the last few months. And for any of you who would want to get involved in gold and silver, you should give him a try.
Well, I can't tell you how much I appreciate that, Mario. It means an awful lot to me. I've admired and respected you long before we ever had a relationship, and the fact that I've earned your trust is something that means the world to me, and we take really, really seriously. We would love the opportunity to work with your listeners and earn their trust as well. Now, our new website that will have live prices and the ability to purchase has been a disaster. It should have been launched months ago. We are at the finish line. The site is all but done. We've already opened it up to our brokers to go through it and find holes and weaknesses. We're just a few days or weeks away from launching it. In the meantime, or anytime, send us an email at info@milesfranklin. Say Mario sent me or Mineco64 sent me, and we will make sure that your listeners get the best price. Personal service will answer any questions they'd like. If you want to be contacted, say so. If you just want the price list, ask for it. We're very, very, very eager to work with your listeners out of respect and appreciation. I personally will make sure not only is it a great experience, but that the price they pay will be unrivaled. So I do appreciate that more than you know, and we will strive to uphold that level of trust that you've given us and make sure it's a good experience for you, not just your listeners. So for what it's worth, thank you very much. I do appreciate that.
You're welcome, and thank you for also trusting me to work with me. And yes,
that's the easy part.
And Andy, just any final thoughts for the viewers before we wrap up?
I guess what I always say, trust your gut, because it seems like something serious is happening. It's taking place. And I think we live in a world of eroding trust, at least of our leaders. And that's something that we excel at. We're really good at trying to earn people's trust and make it a good experience. But I do think we are entering a period of time of upheaval. This is kind of the calm before the storm. All of the things are culminating. The rate increases, the growing chorus of countries joining together around the world with the Shanghai Cooperation Organization, the Belt Road Initiative, and the BRICS, the admission by Saudi Arabia to accept other currencies for oil, the protection of the Saudi kingdom. Heck, this week on Sunday, the U.S. State Department told all Americans to get out of Russia. You got Russia and China in South Africa doing joint naval exercises. That was in Zero Hedge today. They made mention of the fact and the great and how proud Putin was that their submarines all carry the new hypersonic ICBMs that go Mach 8, the fastest missile in the world, and are shrouded in what they called I think a fusion cloud, I think is what they said. They can't be detected by radar and can hit the ground at the speed of asteroid. They can't be knocked down. I mean, things are getting real. And let's hope to God that we aren't heading towards, World War III. I hope not. But when you look at the movements of our administration, they're certainly not doing anything to quell that chance. So I guess the bottom line is simply this: do what the biggest money in the world is doing, and that is to de-dollarize and to prepare the way that the other countries are. Think of China. They're not just buying gold and silver, they're buying all of the commodities, both hard and soft, because they realize in the end that's what matters. We've lived in a world of illusion, of rehypothecation, of paper, of derivatives, of no transparency. And I think we are moving a la Zoltan Pozar into a world of transparency and commodities. And that is what the biggest, most sophisticated, well-informed people closest to the information, not only well-financed, it's what these people are doing. So that would be my advice. Do what the biggest money is doing, not what the rhetoric is telling you to do. And we'd be more than honored to step up to the plate and give it a chance to help you with that portion of your assets that are in gold and silver. And Mario, I love talking with you, as brief as it is. It's always a pleasure. And I look forward to the next time you invite me back on your show. You'll never have to ask twice or twist my arm. I'll be here in the blink of an eye.
Wow, that's great. And I feel like you that the world, there's so much going on. There's like the chance of war. And if you look at all the wars, you go back like World War II, World War One, the result of it is a complete reset of everything.
Transition. Yeah,
Yeah,
that's
I
right.
mean, someone sent me an article today how India lost about 5,000 tons of gold the day before they gained their independence, because basically the British and the Americans gave the British the permission not to make the sterling not convertible for the Indians. So they basically said, yeah, you can have your independence, but we're going to keep your gold. Your
Well, look at what the UK, not the UK, sorry, the European Union just did to Russia. They said, well, those assets that we sanctioned, we're actually going to keep them now and use them to rebuild the Ukraine. I mean,
Yeah,
history doesn't always repeat, but it often rhymes. And
yeah.
if you are looking at this as in a court of law, and you look at what the European Union and the U.S. have done, well, they've given lots of money. They've provided the ammunition and the munitions, the tanks and the Stinger missiles and the drones, and they provided the intelligence on where to drop them. If this was a court of law and this was a murder case, you gave them the gun, you gave them the money, and you told them where to go. You're guilty. You're part of the crime. You are an accomplice. And to pretend that we are not antagonizing a country that is backed into a corner. God forbid that we go down this road. I would like to hope that we don't. But yeah, you're right. Every war like that usually it precedes a transition, just like World War II was the transition from the pound sterling to the dollar, and we're at the end of that rope. What is the next transition? Does this a precursor to a new BRICS currency? Maybe it is. Who knows? One last thing that I'd like to bring up, and then I'll let you run. Very often people ask me, or at least a lot lately, people ask me, is there anything that the US could do or the West could do to pull themselves up from their bootstraps? I found it very interesting in 2020 when the International Monetary Fund came out and asked for a new Bretton Woods. The IMF, 150 countries from around the world, was founded at Bretton Woods. Well, not so coincidentally, just the other day, they published a report that said something to the extent of gold as an international reserve, a barbarous relic no more. So maybe, just maybe, most people always assumed there'd be a special drawing rights that would come up and replace any problems with the dollar. Maybe that's how you do it. You issue through the IMF special drawing rights that are pegged to gold. And maybe that puts the brakes on the massive transition out of the West towards the East when the BRICS issue their gold-backed currency that we've been talking about, or their commodity-backed currency, or however it all plays out. When you have entities like the IMF acknowledging that gold is not a barbarous relic no more, when you have all of these countries accumulating gold, the most since 1967, the second most in history, and using the cover of suppressed price to do so, take a step back and trust your gut. The suppression of price is the ultimate tool of misdirection. The biggest money in the world is using that as cover to reposition, de-dollarize, and accumulate gold. So maybe, just maybe, the West has a trick up their sleeve. I guess we will see. But it's a step in the right direction for the IMF to acknowledge that gold is indeed not just a pet rock anymore and has a role in what's coming next.
I saw that report, and the U.S. Basically has a veto power in the IMF because it's got like a shareholding above 17%. So basically, actually, it's the foreign arm of the U.S. Treasury saying that, and that's significant. So, Andy, thank you again, and hopefully we'll be talking again soon. And yeah, take care.
Mario, you're the best, brother. Congratulations and welcome, Rudy, to the family. I really appreciate our time together. I hope you have a great rest of your week, a great weekend, and hope to get to tee it up with you one of these days when you come down to Florida. Next time I head to the UK, you're the first call I make. But you stay well, and I'll look forward to picking up where we left off. Hopefully not too far down the road. In this crazy world, I have a feeling it won't be too far.
Yeah, and I'd love to play with you in Florida. It's a bit warmer than in the UK. Take
80
care.
degrees today.
Good, good. Here it's more like 45, 50.
Well, you stay warm and you stay well. And again, thanks for having me, brother. And I look forward to seeing you soon.
You're welcome. Bye.